Kerr. I'm the Chief Marketing Officer with Genscape, and I'd like to take a minute to introduce Genscape and our panelist of speakers today. Genscape is unique in its ability to provide hard data with respect to market fundamentals. Genscape invests heavily in developing new technologies to track entire supply chains across commodity asset classes and geographies. These technologies, for example, include aerial diagnostics, thermal imaging, near-Earth orbiting satellites, electromagnetic field monitors, and proprietary antenna networks. By measuring the underlying hard data, Genscape's mission is to deliver exceptional transparency and data granularity across increasingly complex global commodity markets. Today we have three panelists, three speakers. Let me take a minute now to introduce them to you. Rusty Brazil, founder of RBN Energy, President and Principal Energy Markets Consultant for RBN Energy. He is one of the most respected authorities in the field of energy information and markets with an extensive background in energy marketing, trading, and data services. So welcome, Rusty. Dominic Chiricella, founding partner with the Energy Management Institute. He is a featured contributor to the CME Group, founding partner of EMI, the Energy Management Institute, and an expert in all facets of energy and commodity trading, risk management, education, consulting, and financial services. Welcome, Dominic. Brian Bush, Director of Genscape's Oil Markets and Business Development. Brian has over 25 years of experience in the oil industry. At Genscape, Brian is responsible for identifying physical fundamental data needed to help provide transparency and efficiency to the crude oil and refined products market. A couple of points before we get started. We'll be doing a couple of polls for all of you registrants during the webinar. We'll be showing you the results in real time. You'll see a couple of questions pop up just after we get started. We invite you to take the poll. We'll share the information as well moving forward. We also invite you to join the conversation on Twitter. The hashtag is State of Cushing. Participants have already received the slides, but we'll also send the slide and the recording of this webinar after the webinar. And all the webinars and white papers are always accessible on the Knowledge Center located on genscape.com. All registrants will also receive a free copy of the new Genscape North American Waterborne Crude Report. This is a brand new Genscape report on waterborne crude movements across North America. Our time frame for that is 2 to 3 weeks from now. As you wish, you can enter your questions and our panelists will answer them at the end of the presentation. And lastly, we do apologize for the timing of today's webinar. Although we were careful not to time it with the release of our Genscape Cushing storage data on Monday, we forgot about the number that comes out on Cushing. I'm sure people are laughing. It was a misfortunate error on our part. We apologize if some of you have to tune in a little bit late after the EIA, but on with the show. So, a couple of questions that keep coming in. We thought we'd pose them, and then I'll turn it over to our panelists. Three questions we keep hearing a lot about is, what do you think is the crude oil break-even price for most of the large independent shale and tight oil producers in the U.S.? Another question that keeps coming in is, have we hit a bottom in oil prices yet? And thirdly, is OPEC showing any signs of relenting on their market share strategy? So with those questions serving as a context, I'd like to turn it over now to Rusty Brazil. Rusty?
Thanks, although I thought Dominic was actually coming up next.
Right. Okay, well, I'll start, Rusty.
Okay, that'd be great, because I think your slides are up next, and I'm coming after you, I believe.
Yeah, exactly. Okay. Thank you, David. Thank you, Genscape. Obviously, we're here today, and the theme of our presentation certainly winds up in talking about Cushing and the impact it's having on the North American market. Cushing's always been very, very important. It becomes even more important as we look at this first slide, and we look at the main reason and what's happening today. I mean, there's a glut of oil, simply said. We look at this chart, which shows the total crude oil stocks just going through the roof. We're at record highs. Total crude oil stocks probably the highest level since about the 1930s. And at the same time, we're seeing WTI just collapsing. We've been in a little bit of a short-term recovery rally that since yesterday has been fading strongly. We're back into the 40s again. Inventories this morning built another 5 million barrels totally, and Genscape's Cushing number this week was close to 1 million barrels. Next slide, please, Brian. Why did we get to this stage? Well, much like in 1986, when OPEC was challenged by the onset of North Sea crudes and Alaskan crudes and some other non-OPEC crudes, they've been absolutely challenged by this massive revolution going on in the United States, the U.S. shale revolution. Simply put, OPEC is just continuing to lose market share. In November, OPEC made a decision. They were going to deviate from their normal strategy of defending a price and said, well, it's time to kind of draw a line in the sand, and we need to defend market share. And that's where we've been. The market was already in a downturn that began in mid-June, and it's just accelerated since November, with prices currently off over $50 a barrel. As you can see, the target of OPEC, when we look at these slides, is the U.S. At the end of the day, what's been happening in the U.S. has been nothing more than amazing. Production is going through the roof. We're able to bring on oil quickly. The U.S. market is now one of the U.S. crude producers and one of the major producers in the world. And the implications as to what's been going on here in the United States has spread globally. Next slide, please. What we could see is, in spite of the fact that OPEC is looking at most OPEC members are looking at some relatively high numbers. These are very difficult numbers to exactly calculate, but these turned out to be the budget numbers that the various OPEC countries need to break even. Obviously, with the exception of a few OPEC countries, maybe Kuwait being close to it, we're below everybody's break-even level. We're certainly, as Rusty will talk about when we get into the next section, we're approaching break-even prices, obviously, for some of these U.S. production. But this is creating a very difficult problem for OPEC. They're cutting budgets. They're cutting out social programs right now. But they're persistent in what they're doing. Just this week alone, Saudi Arabia and the other major producers in OPEC once again lowered their prices of oil to Asia. Asia is the oil demand growth center of the world, and they're still chasing market share. So one of the questions that David asked about is OPEC showing any signs of changing? It sure doesn't look like it. It looks like they're continuing to go forward with their market share strategy, and the net result is we're continuing to look at lower prices. Next slide, please. So what's the outcome of this strategy? As we can see from this particular slide, WTI is the spot WTI contract has been hovering near a very long-term support. The support line goes all the way on back to the collapse we had in 2008 and 2009. The single biggest difference this time around is the 08-09 collapse was a demand-driven collapse based on the financial system collapsing. We are now in a supply-driven collapse, or an oversupply-driven collapse. much more complicated, much more complex, and the ranking of who's really the most price sensitive, who's really going to become the swing producer. Certainly more and more signs are pointing towards the North American production between the United States and Canada. So the whole world of oil is kind of turned around as compared to the previous years, and thus the solution is going to be much more complicated as time goes on. Last slide, please. So as Einstein said, we just can't solve this problem the same way we solved it in the past. There'll be new solutions. There'll be new swing producers. And always remember, as quickly as U.S. production has been going down, since it is very price elastic, U.S. production will go back up again. So where OPEC fits in the overall scheme of things going forward, where non-OPEC fits in the overall scheme of things going forward, is likely to be significantly different than what we've seen over the last 25 or 30 years. Thank you.
All right, Dave, do you want me to start now?
Yes, sounds good, Rusty. Thank you.
All right. Well, Dominic, thank you for setting things up for us. I would certainly agree that we need Einstein at this point. Maybe he could figure some of this out for us. You know, after the crude oil price crash, the question that we hear most often are, what are the producers going to do? Are they going to stop drilling most new wells? And of course, the thinking goes that then production is going to decline, supply and demand come back into balance, prices recover back to somewhere near pre-crash levels. And to answer all of those questions, we took a look at the economics that producers in the U.S. are facing. But unfortunately, when you look at those economics, there's a big unknown, and that's price. So it's kind of a chase your tail situation. You can't forecast producer behavior unless you have a view on price, but the price is a function of that behavior. So about the only way we figured out how to tackle this situation is using scenarios, trying to use scenarios to understand the relationship between price, producer economics, and ultimately production. So we worked through 3 scenarios, and I'll go through the results of each one of them in a few slides from now, but just to give you a sense of what we're looking at, the first we call the growth scenario, which is pretty much the trajectory that we were on before the crash. Resilient production hangs up there about where it's been or higher because of drilling in sweet spots, held by production, leases, hedge pricing, a number of other factors that I'll get back to in a few minutes. And that keeps production coming on strong for at least the next year or two. And in this scenario, a robust demand response gets the price of WTI back to $80 by the time you get out to 2017. Certainly that's not $100, but it's, at least looking at our numbers, it's good enough for producers to be able to make money on most of the wells that they were making money on pre-crash. Then we have a cutback scenario. There's still resiliency in production in some basins. Some basins start to fall off. There's a modest demand response, but WTI gets only back to $70 by 2020. And that's pretty much the forward curve as you look at it right now. So prices are not great, but it's $20 more than prices are now. So you have to look at it as a reasonably bullish scenario. And then our third case, or our low case, we call the contraction scenario. And even here, we expect production volumes to be up in 2015 relative to 2014. But we don't see a demand response here. Production goes into a decline. Prices hang in the $50 to $60 range, $50 to $60 range through 2020. But even in this low case, production only falls back to 2014 levels by 2020. So with all the numbers that we've crunched, the bottom line is it's going to take a lot lower prices than what we have right now to really set production into a steep decline. To understand that dynamic, we need to look at producer economics, and it's those economics that drive the production models that both RBN and Genscape use to estimate forward production growth. So that's what we'll look at here, and we'll start with how things were in the good old days. In this good old days is the fall of 2014. Crude oil was 90 bucks. Natural gas was 375. Just a little background on these numbers. These are internal rates of return, IRRs, representing the discounted cash flow rates of return for typical wells in each one of these basins. And we've classified the wells by commodity, depending on which commodity, whether it's crude, gas, or NGLs, contributes the most revenue to wells in that basin. These are typical wells. There's a wide distribution of wells in each one of these things, from the best to the worst. We've tried to pick what we think are the representative wells to give you a good idea of what producers are likely to do in that basin. Finally, these are half-cycle rates of return, meaning that they don't include upfront investment in things like exploration or, most importantly, land lease bonus cost. So starting off then with the red dots there, these are dry gas plays. Dry gas plays back in the fall were sitting at numbers like single digits, 5% for Haynesville, 6% for Fayetteville. Up in the Marcellus and Utica, producers were fortunate enough to have transportation out of natural gas capacity-constrained areas. We're getting returns in the mid-teens. If the producers were stuck taking local prices that have been heavily discounted for the past couple of years, they've been pretty close to zero. Quite different for the NGL plays. That's the green dots. Even though NGL prices were down by the fall relative to where they had been, still above gas on a BTU basis. So the Eagle Ford was enjoying rates of return in 24%, Granite Wash 23%. Up in the Marcellus Utica, very good returns, even if they were stuck with selling their gas at local prices. Crude oil at 90 bucks. Oh, those really were the good old days. Somewhere in the 40% range. Bakken, Niobrara, Anadarko, Permian, Eagle Ford. Although the well costs differ across these basins considerably, the initial production rates and decline curves, and those are the two main variables on the volumetric side of these calculations, they tended to vary right along with those investment costs, which is kind of a self-selecting mechanism, I guess you'd say. So the returns tend to cluster around what worked best for a given price environment at that time. But by December, next slide please, things had changed considerably. By December, crude oil was down back to 60 bucks, gas was down to 3 bucks. With those prices, the same wells that were at $40 were coming in to the mid-teens. Should get a click on that. Hey Brian, can you click? There you go. Thank you. So we're down to the mid-teens for crude oil. NGL plays, the green dots there, the middle single digits. Marcellus wet producers with NGL prices coming down, with crude oil dropping below zero if they were stuck with getting low local natural gas prices. Natural gas rates of return dropped all over into the negative range unless they were lucky enough to be up in the highly productive Utica Marcellus region with takeaway capacity. Otherwise, they were stuck with negative rates of return too. That was December. We all know what happened between December and January. That's the next slide. Crude oil was at 45 bucks, gas down to 3 bucks. Crude oil rates of return down pretty close to zero. Liquids rates of return down to zero. Let's see, you should be able to click, give me 2 clicks if you would. There we go. Pretty close to zero on crude, negative on natural gas. On wet gas, dry gas didn't change because the gas price was still at 3 bucks or so. If we work these numbers today with crude oil at $50 or $49 or whatever it is now, and gas at $2.75 or $80, wherever it is right now, it's not going to be much different today. So as you look at these numbers and think about what they imply, there's a couple of important assumptions to keep in mind. Stay on that slide if you would, please. First of all, these numbers are based on drilling and completion costs from 2014. Those costs now, if you were to go out and drill a new well and you don't have commitments to your service providers, you can get prices at 20–25% below what you could do middle of the year last year. Bad for drilling services companies, but it certainly means that these returns will be higher for producers lucky enough to be able to benefit from the lower costs. And it's a relatively linear relationship to price. So if a producer with a break-even price of 45 bucks gets a 20% cut on cost, he gets a 20% cut on his break-even price and takes him down to 36 bucks. So it makes break-evens, when we crunch these numbers next, it will make the numbers, the rates of return higher. It will make the break-even prices lower. Second, these numbers are all based on today's productivity rates, the productivity rates that we've seen in the market for the last year or so. If producers start doing more with less, which I think they're almost bound to do, that will make the rates of return increase, makes the break-evens decrease as well. So these are some of the reasons why we're projecting very resilient production volumes. Rates of return will be improving from January levels that we're seeing here because of that improved productivity and lower drilling and completion cost, even if prices don't improve. But next slide, please. There are some other factors that impact how producers are doing as well, and those are listed, the 6 items listed on this slide. First of all, there's a lot of wells that were in development at the end of the last year, and those wells are going to be completed and be brought online. The producers need the cash. Producers, next bullet, producers are cutting back drilling, but the rigs that are left are focused on their highest yield sweet spots. Exploratory wells, science projects, they're gone. They're leaving only those very best prospects to maximize return by maximizing production volume because, again, they need the money. In recent years, a number of leases have been signed that have included HBP, held back production clauses, requiring that drilling and production requiring drilling and production to be able to hold the lease, and those leases were acquired at significant cost. There are going to be some wells that are going to be drilled to hold those releases regardless of short-term economics. Next bullet. Some producers have hedged their prices, and they are going to continue to drill against those hedges, at least for the next year to year and a half, depending on how smart they were. And finally, as I mentioned a few minutes ago, producer economics are going to be improved by lower drilling and services costs, which are coming off fast. So next slide. What does this all mean for production? Well, this graphic shows 3 scenarios, the Genscape forecast in green, and 2 of the RBN forecasts, the cutback case and the curtailment case. Essentially, those are medium and low cases, if you recall what I was saying a few minutes ago. Genscape production has their numbers coming down a little harder than RBN does in the near term, but both the Genscape and the RBN cutback case, which, if you recall, had $70 in 2020, production continues to grow to a number above 10 million barrels a day for U.S. production by the time we get out to 1919. In this scenario, we see production staying on a growth trajectory, even with prices well below where they've been for the past few years. And then we've got that curtailment case. This is the one where prices stayed in the $50, $60 range. And here, production declines from 2016 on. But look very carefully. Even in this case, production in 1919 only gets back to where it was on average for 2014, not below. So the takeaway from my part of the presentation is that, at least in our opinion, we should not look at U.S. producers to balance global crude oil supply, the global crude oil surplus anytime soon. There's going to be a lot of crude production out there. It all is going to need to go someplace. And with that happy thought, I'll turn it back over to Genscape.
Thank you, Rusty. And Brian, before we get started, we thought we would put the poll up for everyone. The question before you right now is, how low will the price of oil go? So just take a couple of seconds, answer that if you'd like. And to note that we do see a lot of questions coming in. We will answer those questions at the end of the presentation, so feel free to keep sending them in. And with that, anyone who wants to answer that polling question, we'll give you a few more seconds. We'll share the results later. I think we're good to go there. And we're going to turn it over to you now, Brian. Brian?
Yeah, thank you, David. Dominic, Rusty, thank you very much for joining us for this. Very, very interesting as always. We're going to kind of go and focus on what Genscape has been monitoring and what we've seen and how that, I think, is applicable to the market and looking for what may be coming in the future. And anytime you want to talk about the future, it's not a bad idea to understand history and what has happened in the past. So if we go back and look from the time Genscape started monitoring crude oil in Cushing at where that 12-month spread was at, not an uncommon way for people to do a storage play. And Dominic, you said something earlier on that I really appreciated and had noted and was looking at it very much the same way, that the early crash that we saw was a demand-oriented price crash. And it was much stronger in WTI than it was in Brent because a lot of it was the growth of production and crude oil actually being stuck in the Midwest. That's kind of what brought on the idea of crude by rail, starting to move stuff out of the Bakken to different places. That's when we saw the TI Brent spread go blowing out. But we also saw the time spread go out. We eventually saw the time spread get out to almost $24. And at that point, you just have easy storage economics, so every barrel that could possibly go into storage was. As we look at it now, we've gone back into a contango market, and as of December, we hit storage economics again, easily seeing the spread go out past 10.50, and last time I looked today, we were well out to an $11 spread on the 12-month play. If you assume that storage can run you, and let's be generous, let's say that it's going to cost you 40 cents a barrel to store crude, then someplace around between $4.50 and $5 is what it's going to cost you to store crude for a year. So the WTI market is one where the price is actually driving storage as opposed to, in the past, demand has driven storage. So let's look at what's going on at Cushing and where it was the last time we saw this contango market. And the most interesting thing that we see about this particular graph is obviously the build that we've seen in the last 6 months and especially the last 2.5 months in Cushing. We reached kind of a bottom of inventories back in July. We gradually built until November, and by the time we got into late November, December, we started seeing as much as 2.2 million barrels a month going into inventory. We've seen that sustain for a while. This week it started to cut back a little bit. So to kind of put that in perspective, though, what does it mean historically? And if we look at where we were back in 2008, 2009, even though we only put about 44 million barrels in inventory at the peak, and we're actually over that right now, your utilization of existing capacity was close to 80%. And we've never seen utilization ever go much over 80%. But what happened between then and now is the construction of over 30 million barrels of storage capacity. If you look at actual shale capacity in Cushing, there's about 86 million barrels of storage capacity that exist up there right now. We've currently filled up over half of that. So if we consider how quickly we're building, then one of those questions we're going to look at is, when do we think we can actually fill Cushing up? So what happened back then? Back in 2010, 2011, there was only about 1 million barrels, a little over 1 million barrels of takeaway capacity from Cushing, Oklahoma. In 2012, Seaway was reversed. That brought on about 170,000 barrels a day of capacity, increasing takeaway from Cushing, but more importantly, taking away that crude to the Gulf Coast. In 2013, the capacity of Seaway was increased by 250,000 barrels to almost 420. In 2014, we added the Trans-Canada Gulf Coast line. That brought on 640,000 barrels a day of capacity to the Gulf Coast. And finally, in 2015, we've added the Seaway Twin, bringing another 450,000 barrels a day of capacity to take crude away from Cushing, Oklahoma. If you look at that, we now have about 2.5 million barrels a day of takeaway capacity, a little over that, and of that, 150 million of it is crude that's destined for the U.S. Gulf Coast refining complexes. One thing to note in that is some of that takeaway capacity, previously the BP1 line up to Whiting was almost full all of the time. Now we're seeing that line actually run fairly close to minimums as they're taking more and more Canadian heavies into that refinery. So currently, logistics really are not a problem. If we need to take crude out of Cushing, we can. So the things that are driving storage this time around are not the same things that were driving storage back in 2008 and 2009. So let's take a look at what we're facing right now. Again, we saw this graph earlier, but I focused on the very end of it because this is what's happening to us right now. And we see that build starting in January, accelerating at November, and we finally saw that we're getting over 50% full. Of that, we've noticed that rail deliveries to the East Coast and the U.S. Gulf Coast have dropped off by almost 300,000 barrels a day. There's only a modest 40,000 barrel a day increase to the West Coast that we have seen to offset that. So where are those barrels going? Well, about 2/3 of them are ending up in Cushing, Oklahoma. We've seen trains delivering crude into Stroud and going by the Hawthorne pipeline into Pony Express. So we're seeing every possible domestic light sweet barrel that we can find in Cushing. People want that because it provides a true arbitrage at Cushing. We've seen that, I'm waiting on the slide. Yeah, we've seen that storage in other locations, in particular the storage at, okay, that's the one I wanted. We see that storage, when will Cushing be full? If you look at the current capacity and we assume that that 80% max utilization is still a good number, then we'll fill Cushing up in the middle of April at about 68 million barrels if we were to continue that 2.2 million barrel per week build. I don't think we're going to do that. We actually saw a drop off in the build at Cushing this week, and as those people who have had access to storage have already filled up the space that was available to them, then they're going to be dropping out of that market buying storage barrels. And you're going to be left with a smaller pool, but they're still going to be acquiring as many storage barrels as they can. I think that the filling of Cushing is much more likely to occur sometime around the middle of May, and that's assuming that we really can go to 80% of capacity. There's a lot of outstanding questions. Of that new 30 million barrels of construction, how much of that is dedicated to Canadian heavy sours that are destined for the U.S. Gulf Coast refining market? I don't think anybody really knows the answer to that yet. Time is going to tell us when we actually cap out and the builds level out and we see Cushing start to flatten out. But I very much think it could be close to that 80%, and I think it will occur sometime in the middle of May. So what happens when Cushing is full? Well, currently we're moving about 1.6 million barrels of crude into the U.S. Gulf Coast. That leaves us with about 700,000 barrels of excess capacity just through the pipelines from West Texas and Cushing to continue moving crude in there. So we can easily absorb the 2.2 million barrels a week that we've been putting in storage, and we can get it to the Gulf Coast refining complex. Now, in addition to being able to move it there, we do have storage capacity between Corpus Christi and Beaumont, the Texas Gulf Coast, that is in excess of 50 million barrels. You have another 25 million barrels between St. James and West Texas. So we believe there's at least another 75 million barrels of capacity out there in the areas that Genscape currently monitors, and that does not include barrels that could be stored in loop. Now, of course, you can't store that whole 75 million barrels. There's going to be a utilization capacity cap on that, and I think that utilization will be considerably less than 80%, because much of this storage we monitor is actually at refineries. It is operational storage, and it's not, you just don't have as much merchant storage available in the Gulf Coast as a percentage as you do in Cushing, Oklahoma. So we do have, the bottom line is we have room to put crude once Cushing fills up, but it is limited, and at the rates we've been producing, we could see the storage in the total U.S. really become critical sometime before the end of this year. If we look at some of the other storage areas we monitor, we've actually seen crude drawn out of those areas, especially West Texas and the Gulf Coast, for a while. About 2 weeks ago, we saw that trend reversed. And then we started actually building crude in those areas along with Cushing. And to be building crude in all of those areas, plus building inventories as rapidly as we are in Cushing, it's not a surprise to me at all that we've reached all-time highs in crude oil inventory in the U.S., and I think we're just going to go up and up and up. You've also seen that the grade price differentials on the Gulf Coast have gone up as we've been pulling refinery supply out of the market and keeping it in Cushing, and we've seen the WTI Brent spread move in basically the same direction. So what does this really mean for the future? How do we get out of this? I think there are three different ways that we can work our way out of this. It's not completely out of line with what Rusty was saying. I'm just kind of trying to look into a crystal ball and say what can cause those. One of those is a supply solution. So if OPEC blinks, or if we have instability in a significant crude producing country, that the unrest cuts global supply out of that country. Now, if we could get 1 million barrels a day out of the supply, we could actually reverse that trend and we could get out of this fairly quickly. The second option is we see economic growth pick up, especially looking to China and European Union. An increase in the demand for crude would get us out of this problem in a more midterm. The worst case scenario is if we actually have to wait for E&P companies to go to the sidelines for production to fall. That's a much more long term. And the longer we're in this and the more we build inventories, the more we build a storage hangover. So once we do start to see production cut back, once we do get close to that balance, then we have to work all of this excess stored crude off, and during that time, crude prices are still depressed. People do not enter the exploration and production as quickly as we wish they would. We get to the point where now we have a shortage of crude and we go back into the boom cycle. This is what we've been doing in the oil industry for about the last 100 years, the boom and bust cycle. And I think that history is destined to repeat itself. It's really only a question of when does it repeat itself and how long does it take us to go through the cycle.
Thank you, Brian and Rusty and Dominic. So let's get to some questions here. Question number one, will the depressed oil prices encourage loosening of the crude oil export regs? And I'm going to just throw the questions out and either of you can jump in.
I'll take a shot at it. You know, there's that issue is mostly around politics and not around supply-demand, the supply-demand dynamics. But if you look at the price differentials that we have right now in the market, price differentials wouldn't support crude oil exports even if we could do them. Crude oil export or exports of condensate have backed off considerably over the course of the last few weeks, simply because the differential between U.S. crude prices and Brent international crude prices simply won't support it. My thinking is that by not importing crude oil, and we wouldn't be importing crude oil if all the things that Brian talked about came to pass, we wouldn't be importing nearly as much crude oil as we are right now, I should say, then that's just the same as exporting. We don't need to physically export the barrel to have the market impact. We just don't import that same barrel, and the effect on the world is the same. So we will have an impact on the market by the increasing production that we're seeing in all the scenarios that we've been talking about here, but it is not necessary that we have a lifting of the export ban to make that happen.
Just to add what Rusty said, we can't lose sight of the fact that we're exporting over 3.2 million barrels a day of refined products, and that's slowly growing.
Absolutely.
Excellent, thank you. So next question, I know you've talked about this a bit, a broad question. How do you see the evolution of the Brent WTI spread over the coming months?
I'll like to comment on that. I think, as we saw, it was very interesting with the opening up of Cushing. The spread evolved back down to parity just a couple of months ago. And what's actually happened is we're actually back in a building mode in Cushing. As long as Cushing continues to build inventories, Brent is going to continue to trade at a premium over WTI. If and when the inventory destocking starts again 6 months from now, a year from now, or whenever, then I'd say there's a modestly high probability that we're going to get back towards parity again.
Yeah, I can't add much to that. I agree that we're probably headed back toward parity, and the more crude that ends up being surplus, the more likely that's going to be.
Excellent, thank you. Next question.
One more thing.
Yeah, go ahead.
Just a last thing on that. I mean, there's a bit of a school of thought building that with North American crudes being much more price elastic than a lot of conventional crudes, there may be a lot more emphasis coming back towards WTI as a marker versus Brent, which would also support the return to parity.
Excellent, good point. Next question, understanding the point of U.S. shale producers being able to continue production in large part due to prior hedging, HBP, lower break-evens, etc. Can you speak to the capital markets component? And by that, the supposition is larger U.S. players may maintain access to that capital. But what about the smaller E&P players? Will they have the same economics and access that they had over the last 2.5 to 3 years?
It's not anything that I'm an expert on, but certainly the smaller guys are going to have a harder time raising capital than the larger guys. If the rates of return are there, my prediction is somebody will drill the well. Either it's going to get farmed out, or the guy is going to get sold and wrapped up into a bigger company, or something else. But if the opportunity is there, if I'm sitting, even if I'm a small guy, if I'm sitting on a prospect that's got a $35 WTI break even and WTI is at $50, I'm betting somebody's going to drill that well.
Excellent. Next couple of questions I think are more for you, Brian. The questions are focused on are we seeing a variance between the EIA's working storage capacity at Cushing versus our internal data? And a reference point is the latest EIA data point from September is 71 versus our 80. And could you just walk us through that variance?
Most of that variance is due to the way the EIA reports storage and the way we report it. The EIA reports what they consider working inventories. So bottoms, heels, tank heels, those are not included in anything that the EIA reports. We report on shale capacity alone, and that number I'm mentioning, we're not even showing 86 as capacity right now. We still have some barrels, some tanks that we are showing in maintenance. They have absolutely no oil in them right now, but they could come online fairly quickly. So the 86 is total shell capacity that is built at Cushing, and when we report inventory, there is always a variance of 4.5 million barrels, something in that neighborhood, where we're reporting the tank bottoms with our number, because we're just reporting the entire volume in that tank given the shell capacity of it, as opposed to the EIA trying to report a working storage number. The change in inventory week over week should basically be the same for both.
Okay, thank you, Brian. Next question, I think for you too, is can you comment about the Flanagan South Pipeline to Cushing? How will that impact storage? And digging into this, there was a Reuters article the other day mentioning that shippers could store at Cushing without penalty, which would make sense, economically speaking, at the current time spread. So looking for comment on Flanagan South Pipeline to Cushing.
The agreement with the Flanagan pipeline that allows people to put barrels in storage for up to 12 months free, that's golden money for anybody that actually has that in their contract. And you know, part of the question is, does it have to be barrels that come down Flanagan South that go into storage, and are they getting enough crude that meets the domestic sweet spec to deliver against contracts? And I don't know the details of that. If I move X amount of volume down the pipeline and that allows me to store X amount of volume free, and I can move heavies down and pass it on and still store domestic sweet, that is the best of all situations for those people wanting to do a storage play. If it means that you have to store what moves down Flanagan and you're not able to move enough domestic sweet, then you're talking about maybe storing a heavy sour in Cushing, trying to hedge that with WTI. It's still a very good bet, but you're absolutely opening yourself up to a basis differential between light sweet, medium sweet, and heavy sours.
Thank you, Brian. Question for Rusty, but Dominic, feel free to chime in too. But based on your analysis, it really looked like crude prices will stay lower stay lower and longer than some folks had thought. Just question is, are we reading this right, and can you just comment on that, and maybe even how long it took for the last storage hangover to clear out?
Well, I'll take the last part of that. I was working for Texaco in 1986. Last time we had a real supply-driven collapse, and I had just talked my boss into letting me trade futures for the first time. I took a long position in the first of '86, and can tell you generally what it looked like on the screen for the next 3 months as I watched my position slowly vaporize. I thought, you know, I'm going to be right one of these days, and of course I was. 3 years later, the price got back up above where it had been before the crash, stayed there for about another 6 months, and then declined back below the crash level for another decade, meaning that basically it was 14 years before the 1986 crash corrected itself. There were a lot of factors happening in 1986 that are not happening now. I don't think that we're as in nearly bad a shape. That million barrels or so out of balance that Brian was talking about is nothing close to what the situation was in 86. But for all the reasons that I talked about on those slides, I don't think it's 14 months either. I think it's going to take a while to work through not only the supply-demand balance in the marketplace, but also that supply overhang that Dom and Brian have been talking about. That supply overhang is happening not only at Cushing. There are a lot of boats floating around out off the coast of Singapore right now in exactly the same play. So all of that crude that's being stored right now because of the contango situation is going to have to be absorbed as well as the supply-demand imbalance. I think it's going to take a while for that to happen unless some of the scenarios that you guys were talking about of disruption in the Middle East changes the supply equation dramatically.
Yeah, I very much agree with you, Rusty. It's in addition to what you were talking about in the mid-60s, just a little closer time period. If anybody wants to go back and look, and I'm talking about the cycles repeating themselves, go back and look at the late 90s, early 2000s. That's back when we saw crude actually go down to almost 1050. There was a very steep contango curve back there. A lot of barrels going into storage. It took a long time to work that off. We saw the same thing in 2008, 2009. We were able to work that off a little faster, and part of that was it wasn't the overall global oversupply. Remember, WTI Brent went out to over $27. This was mainly you had an oversupply in the Midwest and no place for it to go, which drove WTI so low. So that one turned around fairly quickly. If you want to look more at something like what we're facing right now, go back and look at the contango market that existed in the late 90s and early 2000s.
Thank you, Brian. And,
for what it's worth, this week we had the monthly forecast from EIA, IEA, and OPEC, and in all those forecasts, they were all at least through 2017 or so. Still showing no significant recovery in price. I think we're really in a new market. I think barring a geopolitical event, I think it's difficult to come up with a scenario where we go back to prices we had before the crash, and really even in the longer term. I mean, in fact, from a geopolitical point of view, the next major event might be just the opposite. If the U.S. and the P+5 do actually conclude this negotiation favorably with Iran, we can easily see another 1 million barrels a day of OPEC oil coming into the marketplace by the second half of this year. So I think we may have even a whole nother ball game, just the opposite of what we've been seeing on geopolitical events facing us.
I guess if you want a single takeaway from that whole little discussion, it's I don't think any of the three of us believe we've seen the bottom yet.
Yeah, I agree with that.
Thank you, guys. A couple more questions. So we're also putting up the results of the first poll, so you can see that, and then we're going to launch another poll as we ask some more questions. I think we have about 7 minutes left. One question is just, why is the U.S. still importing so much crude, especially during turnaround time?
Well, we haven't really started turnaround yet.
Okay.
That'd be number one. And number two, again, I think we have to look at, in my view, we have to look at what the U.S. imports or doesn't import is really not completely out of necessity. It's an economic optimization. If refiners can make more money running Nigerian crude today than they can running Bakken crude, then that's what they're going to do. And as Brian or Rusty alluded to, the reason why exports don't make sense right now is because a lot of imports make sense. Some of the imported crude is more economical than some of our domestic crudes at the moment.
I agree, and also you have to look at things regionally. Like there's no really good way to get the bounty of shale crude out to the West Coast. So these guys are stuck with Californian A&S crude and imports from other countries, and that's not going to change for a while.
So picking up on this conversation, another question is, which U.S. basins should we look to be affected by the decline in crude prices first? Bakken, Eagle Ford, Permian, etc. Which U.S. basins should we look to be?
I think both Eagle Ford, well, it's hard to say. I mean, you can come up with some pluses and minuses for each one of the basins. On the Bakken was really just getting started, and starting in about a year or so ago, with being able to figure out where the really hot spots were to drill, and there was still a lot of science going on. That science will slow down, and so that'll be one thing to watch in the Perm. In terms of the Eagle Ford, there's a lot of condensate. We figure 45% condensate in the Eagle Ford. Condensate has been hit harder than crude oil, and so that is going to affect producers' economics there and make them more likely to go other places where they can see better results.
Can I add one thing too? The Bakken is an area where the largest mode of transportation is rail, and that's the most uneconomical mode of transportation, which in essence drives the FOB price in Bakken down even lower. So you could see that having implications on Bakken in the short term too.
Yeah, and I want to step out of your question exactly like you asked it. I think the first thing that's actually going to be hurt that in a longer term could be significant is not necessarily cuts in one of the existing basins where there's a lot of production going on. But if you look at the Tuscaloosa Marine Formation in Louisiana and Mississippi, it's absolutely a great crude oil, but it's deep, it's expensive, and I think what this is going to do more than anything else is really delay the development of that field. But everybody needs to remember that it's sitting out there and it'll be available for development as prices get back up into the $70 range.
Thank you. So we're going to ask just a couple more questions, and then anyone who didn't hear their question answered or has a new question, would like a free trial of any of our products, we're sending out a follow-up email, so just feel free to reply to that. Last couple of questions. With declining North Sea production, current prices discouraging future production in the North Sea, and OPEC countries now aggressively discounting prices to keep market share, do you see the Brent contract remaining relevant going forward?
I mean, this is Dominic. I do. I mean, in essence, I mean, certainly Brent production is going down, but Brent is not Brent. It's four different crudes. It's BFOE, and certainly North Sea production is certainly not growing, but it's stabilizing a little bit. So I think for the foreseeable future, I don't see a change in Brent as a benchmark. Although, as I said earlier on, market is looking at more potential for WTI maybe gaining back some of its luster as a benchmark versus Brent as the North American market becomes even a greater factor in the global supply scene going forward.
I agree with Tom that once a benchmark has established itself, it's very, very difficult to dethrone it, and so I think Brent is going to be there, and to the extent that Brent has problems being a benchmark, I think they're going to fix it, just like they've been fixing it, adding those other crudes into the pot for the last few years.
Okay, thank you. One more question. Will there be any movement in storage costs significant enough to affect the contango in the WTI curve?
I would be very surprised. I would be surprised if there's very much storage space that's actually available to anyone in the marketplace right now. With the market where it is right now, if you don't already own storage, whether that's outright owning storage or you've leased the storage, I would think there'd be a real premium, and the people who own it are going to utilize it as much as possible. That's certainly true at Cushing. Whether or not it's true on the Gulf Coast yet, I'm not sure. The other thing to be watching on the Gulf Coast is we're currently monitoring the construction or development of what could be almost another 40 million barrels that could come on sometime in the next 6 to 18 months. Everything from 17 million barrels in a salt cavern south of Houston to tanks that are being built, especially a couple of developments in Corpus and an expansion of several of the terminals around Pasadena and Houston.
The other variable.
The other variable to add.
With Brian. Go ahead.
Hey guys, just don't forget, if you're not speaking, to mute your phone, and that'll stop the echo. So if you're not speaking, please mute.
I mean,
okay.
Just the other variable to add to Brian.
With contango has been what's been driving the vast majority of this storage action. I think most people are going to be of the belief that contango is not going to last forever, and that at that point storage is not going to look so great. So I don't see much change in storage costs either.
Just to also add the variable to it is we still have a lot of potential storage opportunities in floating storage. Last estimate I've seen puts floating storage at about 40 million barrels right now, which is about 20 vessels. That's way below the level we were at in 08, 09. So potentially there's still a lot more storage for that. Again, if more floating storage opens up, that'll certainly keep a little bit of a lid on some of the domestic or land-based storage also.
Thank you very much. So I think we're out of time. I want to thank our panelists, Rusty Brazil, Dominic Chirichella, Brian Bush. Guys, thanks for an excellent presentation. I think we had some interesting questions and a great conversation after. Again, we will send out a follow-up email with the recording and the slides. We encourage anyone to reply with questions, to speak to an analyst, to get a free trial, or whatever you would like in terms of feedback. Thank you again. We're concluding the webinar now, and have a great day. Thank you. Goodbye.